your Real Estate Real Talk today. We're focusing on mortgage rate buy downs. They're becoming a popular option as interest rates just remain so high. So here to explain is Los Angeles real estate agent Keri White. Keri, thank you so much for joining us with these explanations today.
Yes, of course. Yeah, very helpful with these soaring interest rates right now.
Yeah, so I guess the first question is for everyone out there who might not know, what is a mortgage rate buy down?
Right, sounds a little complicated, but super easy. So with high interest rates right now, buyers are able to get their mortgage rate lower by a series of 1 year, 2 year, 3 years. But it is the opportunity for a seller, a developer, or even yourself to pay a certain percentage of the loan, and you will get a lower interest rate for the first year, second year, third year. There's a few different options, but that's it in a gist.
Okay, so when looking at that at first glance, I would say that sounds pretty good. You're here to explain exactly how they work before we jump into something like that.
Yes, of course. So you've got the 1-0 buy down, in which the contract interest rate drops 1% the first year. So if the rate right now is 6%, you would get it at 5%. The 2-1 buy down, in which the interest rate drops 2% for the first year and 1% for the second year before returning to the regular rates. And then the 3-2-1 buy down is which the interest rate drops 3 percentage points the first year, 2 the second year, and 1 the third year. This isn't saying that your rates are 3%, 2%, 1%. They're dropping lower than what the average interest rate is at that time. So, for example, if you have $1 million loan and you have a 1 percentage point difference, you'd be saving about $600 a month. And on a $500,000 house, which is about the average, you're saving $250 a month just with 1 point difference on your interest rate.
Those are some pretty significant savings when you think about it in the long term. So what are some things to consider before you start agreeing to one of these?
Well, good. Yeah, really good question. So there's this really fun term right now that's called marry the house, date the rate. And there's a lot of controversy over this saying because just because you're dating the rate, if that rate goes back to the regular rate, which it will, and you actually can't afford that monthly payment, you're going to be in a situation where the house doesn't work for you. So it's really important to make sure that you can afford the interest rate that is the norm, because rates may not go down. So if you're planning to refinance to keep that lower rate, that may be something that's completely out of touch. And also, if the seller, you may be in a situation where the seller has some flexibility to offer you that rate buy down because somebody's paying for it. But if you yourself are paying for that buy down and you're not actually saving enough money monthly, like say the buy down's $10,000 and you're saving $250 a month for a year, that's only $3,000. So that's another $7,000 you may have paid towards it. That doesn't matter. However, that could be helpful if you're needing to redo carpets or paint, or you need some extra cash. So there's a lot of different ways to evaluate whether this works for a buyer. And again, it's why you need a good lender and a good real estate agent to go through all these nuances to a mortgage rate buy down.
So, Keri, what would you say are the markets that are seeing maybe the highest number of these types of buy downs, and which ones just aren't seeing them at all?
I love talking about that markets across the U.S. since we have viewers in so many areas. But San Diego in Southern California, 73% are using these buy downs right now. Then you have Phoenix, Arizona, very hot area, 63%. Good old Portland, Oregon, 62%. Vegas, 61%, and Denver, 58%. So you're seeing that these cities that are popular, it's more than half of the loans right now are using mortgage rate buy downs. And then you see the lowest being places like New York, San Jose, Boston, which could be some of the more high-end markets because you're seeing more than 30% of those transactions being cash, actually. So there's a lot more money in those areas, essentially. So that's kind of a comparison of the highest and lowest across the U.S. right now.
All right, so the big question that a lot of viewers want to know right now, your opinion here, is it worth it to do a buy down?
I really think it is, especially because interest rates were at 7% last October, November, and then they were at 6%. And we know how much of a dramatic difference that is monthly. The higher the loan amount, the more you're saving. So if you can get that credit from the seller, say the market's the house has been on the market a while and they're willing to offer you 10 or 20,000 and you're able to save 1,000 to 1,500 a month. The buy down isn't as good as just buying down your rate in general, which you can't do on all loans. So a buy down would be great if you are in that specific situation, but if you can just do a mortgage buy down in general, that would be my advice on a good option for you to save some money. Because rates being 6% right now, most people are still able to get a rate in the high 4s, low 5s. So make sure you're checking in with your local experts to find out exactly what these rates mean to you.
Yeah, well, Keri, you are our local expert here, so thank you for your advice. Truly appreciate it every single week. That was so interesting. You guys tune in every Wednesday for more Real Estate Real Talk. You can follow Keri in the meantime on Instagram. Check it out at Keri and Keri Ann. Subscribe to her YouTube channel, Keri White Real Estate. We'll see you next week. That was so good.